Hi everyone, welcome to our Week 4 class live session for FIN4501 Investments. In this segment, we're going to focus on portfolio performance evaluation. This is a critical topic for both investors and portfolio managers alike. As always, if you have questions, feel free to reach out to me by email or phone. Let's dive right in. Let's start by revisiting two major approaches to investment management, passive and active. With passive management, the focus is on allocating capital between cash and a risky portfolio or adjusting allocations within the risky portfolio. Think of it as a set it and forget it strategy. It's not entirely hands-off, however. Even passive strategies can involve periodic adjustments based on the investor's changing risk perception or changing goals. Passive management, even if the portfolio is updated, is basically focused on the level of risk of the portfolio in conjunction with the stated portfolio goals. Active management, on the other hand, is a different story and is far more difficult. It involves forecasting future returns, either for the entire asset class or for individual securities. Risk levels are fairly stable, but expected returns are not. Successful forecasting of future prices and rates of return is very difficult in the highly competitive markets available today. It requires either private information, which is illegal, or perhaps some better analytical or instinctual method of analysis. You may remember the Trainor Black model from earlier. This model allows an investment manager to build an actively managed portfolio based on security analysis and statistical modeling. So active management attempts to add value by beating the market. Now let's talk about why we evaluate performance. The big question we're asking is this: are the returns actually worth the risk and the fees? Looking at the average return alone is not enough. Why is that? This is because average return might not reflect the expected return going forward. Plus, it does not account for risk. Remember, market performance is a major component of investment returns, so we need tools that help isolate how well a manager or portfolio is doing beyond what the market itself delivers. That's where abnormal performance measures come into play. So, how do we measure abnormal performance? There are two basic approaches. Comparisons to peer groups. This is where we rank fund performance within a specific category. Benchmark comparisons. This is like comparing a fund to a relevant index. But what we really need are risk-adjusted measures that take into account the amount of risk taken to earn those returns. Some of the most common include alpha, the Sharpe ratio, and variations of the Sharpe. These metrics help us evaluate whether the manager truly added value. When we talk about peer group comparisons, we're referring to a comparison universe. This is essentially a set of mutual funds that share similar risk profiles. So if you're managing a growth fund, for instance, you would not compare it to a bond fund. You'd compare it to other growth funds. This helps provide context for performance, especially when evaluating managers. There are several ways a manager might achieve abnormal performance. Let's walk through them. Asset allocation. This means getting the big picture right across various asset classes. Sector or industry selection. Here the manager is overweighting performing sectors, those that are outperforming, and underweighting those that are underperforming. Individual security selection. This means picking the right stocks, the ones that exceed expectations. Each of these elements plays a role in helping a portfolio outperform its benchmark. First up in risk-adjusted performance measures is the Sharpe ratio. This is most useful when you're comparing complete portfolios that will not be mixed with others. In practice, we use the Sharpe ratio when a single manager is responsible for the entire portfolio. It tells us how much excess return we're getting per unit of total risk, where total risk is measured by standard deviation. Next, we have the Traynor ratio. This one is a bit different. It's used when evaluating a portion of a portfolio, perhaps just the equity sleeve which one manager handles. Here, risk is measured not by total volatility, but instead by systematic risk, or beta. The Traynor ratio tells us how much return the manager generated for each unit of market risk taken. Let's shift gears and discuss market timing. This strategy involves adjusting your asset mix based on expected market movements. Think shifting between stocks and bonds or cash, depending on forecasts. In theory, and with perfect foresight, this strategy works like an option. You would only be in the winning asset class at any given time. But in reality, very few managers can time the market consistently, and there is little evidence to support market timing as a reliable long-term strategy. Let's consider a fun example. If you had invested just $1 back in December 1926, look at how it grows under different strategies. If you stayed in money markets, you would have $20 today, safe, but not very impressive. If you stayed in stocks, your $1 would grow to over $1,600, a strong case for long-term investing. But with perfect timing, always being in the better performing asset each month, you would have over $36 billion. Yes, that's billion with a B. Of course, this is purely theoretical. Nobody has perfect timing. But it does show the potential power of asset allocation if it can be done with perfect foresight. This wraps up part 1 of our week 4 lecture. If you have any questions about performance evaluation, passive versus active management, or simply how to interpret the Sharpe and Traynor ratios, please don't hesitate to reach out.